so that they've been in the industry for that long. But what I'm trying to say is what they do in KYC over there or any part of the world is different from what we do in the UK and, well, the rest of the world. So, but I'm just going to give us a quick background into KYC, how KYC really came into existence and how it all started. It all started because I'm sure you would wonder sometimes why does the bank need this information? Why is this information necessary? Or maybe there's something happening on your account and you'd like, what's going on? Why do they need this much information? Okay, it's not like I'm doing something illegal or anything. Okay, but that is KYC. And now I'm just going to be showing us a quick background into why KYC, and how KYC have come into play and come to stay. So I'm sure you've heard of instances of individuals and say a group of individuals, exploiting other people, on social media. You must have come across this on the news. It's not new at all. On the lip of everyone, you would hear. In fact, I was on Instagram 2 days ago and I saw three Nigerian boys displayed their picture on there, saying that I think they defrauded a telephone company, of mobile devices and all that. I'm sure a few of us must have seen that. And they for over 400,000 pounds. So that is fraud. That is, so all of these things, they are taking advantage of whether businesses, whether the vulnerable, where even the public figures, people take, all these people with this criminal act, they take advantage for what? For their financial gain, for their financial benefits. Okay, for financial gain and for financial benefits. So we've said here that instances of these individuals, or group of individuals exploiting others, is alarming and common in news. And that's what I've just said, even in the word of mouth. So, and because of this, there are regulators, there are regulatory agencies and government. The government in the UK and all over the world has continued to back regulatory agencies, to back them in order to find ways to continue to fortify all the measures, the safeguard measures for, to guide against criminal activities. So they continue to give backings to regulatory agencies. I'm sure you've heard of regulatory agencies, but we're going to touch on everything that I've said here. So we're going to be touching on every point here. So because of those guys that I told you I saw on Instagram, so that those acts will not continue to happen, okay? The government and the regulatory bodies or agencies, they've continued to find ways, to fortify all process, all requirements, all measures, so that those kind of acts will not continue or will be reduced. Even if they can't stop it, it will be reduced. Okay, so I just know that you and I, it's not new to us. It's not new to us, So events as well, not just individuals and events, or events as well. For example, in the past, say in the past 2 decades or so, there has been several events that has happened, and we've seen those kind of individuals and group of people take advantage of these events. So in the past 20 years, numerous significant occurrences have posed threats and risk to the global economy. So a few events, including the 911. I know we've heard of that 911. It's a common one. It was in 2000 and was it 2009? So we have the 911 there, 2011, sorry, and then we have the COVID-19 that just recently happened. We were involved in that. And we have this current Russian invasion, okay, that's happening, that's still going on. So events like this, create, gaps, if we open loopholes for criminals, for criminals to carry out their criminal acts, on, say, individuals, the elderly, the vulnerable, businesses, even on a country. Okay, even on the country, they create, they use events like this to. So I've said here that throughout the years, the authorities and regulatory agencies have decided, dedicated efforts to establish preventive measures and to mitigate risk that stems from criminal activities. So like I said, but I'll be going into the details. So this is I'm just trying to like scrape the surface so that you guys can, I'm just trying to like paint a picture here. So when I say COVID-19, for example, here, we know the COVID-19 that happened, a lot of people took advantage of when, say, for example, when there was this bounce back loan, maybe a few of us that just came in would not know about that. A lot of people took advantage of this grant. They applied because it has government backings. They applied, fraudulently. Okay, and they got loads of money, and some people have been caught up with right now. Some are in jail as we speak, due to criminal, fraud applications and all that. So a lot of people say that with this Russian invasion, Russia, companies, businesses in Russia has the opportunity, even individuals have opportunities to move funds, out of Russia, funds that we don't know the source, funds that could be illicit funds. Some people use means of charity that that are providing aid to Ukraine. I'm just painting this the way it is to Ukraine or to, the people that have been impacted by this war. So they reach out to people, get people's money, and all in the name of charity that they are supporting. And, they squander, they take this money, they go away with this money and all that. So we've seen different cases. And with the 911 case, which I want us to, because since that 911 event, there's been a dramatic change. There has been the dramatic impact within the, say, for example, financial industry, within, in all over the world, global economy felt the 911 impact, and which I'll talk a bit more. And that's ever since then, KYC and AML has been really, we've really taken it serious. Banks have taken it serious. Regulatory bodies, agencies, governments, they've taken it really, really serious. So a bit of another background is when we look at all these things that I've been explaining from a financial institution, because I work within the financial institution. So it could be a banking financial institution or non-banking financial institution. Okay. So when criminals carry out their activities, financial institutions could be involved. They could be involved in this act, and they could be part of this as a victim. If not, they could be part of it as a part of the perpetrators or as an instrument. I'm going to explain that further. So they could be used as a victim. Say all the money that is involved, that being moved from one place to another, they go through banks. The banks may not know that these funds are illicit funds, and that is using the bank as a victim. Because obviously when the regulatory body comes, they come to the bank, they verify, they look at everything that the bank has done. And when they spot this kind of transactions, say transactions or, movement of funds, and the bank did not detect it, the bank became a victim, and the bank would have to face a grieving consequence. Okay, an engraving consequence. And also, they can be part of the perpetrators because we have staff in the bank that can work, that always work. We've seen that even from the country that we came from, that we see that this staff, the bank staff, You understand? They work with these criminals out there, okay, to carry out this illicit act, this criminal act. And also, bank can be used as the instrument. And obviously, we've seen that when they obviously, like I said, when they move funds. So the bank has been used, apart from the bank being a victim, they have been used, to deliver. When you see all this terrorist financing, this funds come from, this people through the bank. So the bank is the instrument. So those are the three ways the banks can be involved. Financial institutions can. So each time on this call, when I say banks or when I say financial institutions, I mean the same thing. Okay, so they can be involved. So they can be a victim, they can be part of the perpetrators, and they can be an instrument as well. So, just to cap that up, so they can directly commit financial crime. So financial institution can directly commit financial crime. Okay, so through these ways, being a victim or not, okay, and they can be used as third parties to commit this crime, and these are the things that I've explained earlier. So I want us to quickly look at the example of the 911 and how criminals have used that incident, the 911 incident, as a means for financial crime. I mean, I don't know if you get what I'm trying to say here. So the 911 event to some people became was done for financial gain. And in some cases, some group of people or individual, they carry out terrorist attack like this, not for financial gain. So I want you to hold that at the back of your mind. When incidents of terrorism happens, some people, because they are against the government, or maybe because they are rebels or anything, they can carry out, for religion purpose, for anything, so they can carry out this terrorism. Okay, but doesn't mean that they are doing it for financial gain, but some does it for financial gain. Okay, so the 911, as demonstrated by the attack in September 11, 2001 on the World Trade Center, the hijackers used US and the foreign financial institutions to hold, to move, and to retrieve their money. So how have they done this? So, because obviously now the attack didn't just happen. Some group of people would have financed the attack, because all the sophisticated weapons, maybe it was a bomb or anything that was used for missile, whatever that was used for that attack, for it to have moved from one location to another, some people would have been paid. How were these people paid? Where did this money come from? Okay, and for them to be able to disburse money from here, funds from here to another, they have to use the bank. Obviously, they have to use the bank. They have to use a financial institution, whether it's a bank or a non-banking financial institution. Okay, they have to use a financial institution. Are you with me? Are you with me? I just want someone to say,
Yes,
yeah,
we're here.
great. Okay, great. So they move these funds, around, for them, that funds would have been somewhere. It could be from a religion organization. It could be in their account somewhere. So they've moved the funds, hold it. And so for this 911, part of what they did was the hijackers deposited money into the US accounts, primarily by wire transfer. That's after this has happened, okay? So through wire transfers and deposits of cash or traveler's checks, because obviously the funds will not just come all at once, because they don't want the bank to be suspicious of this activity. Because the bank, you can't just move 1 million without giving the bank a reason, something reasonable for the use of that money, the purpose of that funds. Okay, so they've done it in several different ways, maybe through cash, travelers checks, from overseas, or maybe, different, America, they take different forms of, legal tender. Okay, so the hijackers, they did this through, deposits of wire transfers, cash deposits, and all. So financial institutions can be used, that's what we've been talking about, without their knowledge, to channel terrorist funds or other crimes. So the effect of 911 were felt almost all around the world. And even we that we were in Nigeria way back then, okay, we felt it. We know there was, there was an attack on in America on the World Trade Center. And that has, many governments, including the UK, began to introduce new anti-terror legislation into combat, so into the fight to, into combat the for the perceived threat of, terrorism on, the on the world, on global economy and all that. So they start to put in things, measures in place. And part of the measures in place is, the KYC. KYC has been done even prior to that time, but it became serious. Let me put it that way. Okay. They now start at this time, since then, because obviously we need to know. Anyway, we get to that. Let me not jump the gun. So ever since then, measures have been, new measures, to combat this terrorist financing, terrorism in the world, wherever, in a different region, has been put in place. So I've been talking about regulatory bodies, agencies, and all that. I'm going to go into that, but I want us to look at, this also from the regulators and, government, and you as a financial crime analyst, okay, point of view. So adequate supervision is critical to tackling financial crime and providing a streamlined regulatory environment where business can operate. So since that 911, we've seen that adequate measures need to be, because there were a lot of people that were impacted by that incident. Businesses, even the world shook from that incident. Okay, from the economic standpoint. Okay, and for businesses to continue to grow without fear, for you and I to continue to bank, to continue to do things, financially without fear. Okay, measures, critical supervisions, monitoring, all of these things have been put in place to continue to help us, live in a world without fear from a financial standpoint. Okay, and with this Russia, I gave that example, and I'm not going to go back into that. But we can see that with Russia, there are illicit funds coming in, and we can see that the United Kingdom has imposed sanction on some Russian businesses, even the country, Russia itself. Okay, so and we will talk about what sanction is and all that during the course of this training. So therefore, businesses served as the first line of defense. So when I say businesses, the bank, the financial institutions, whether you give loans, credit cards, that's what you do, or insurance, pension, or the investment management, portfolio management company, or whatever financial institutions, businesses, they are the first line of defense. And business will not run itself as a first line of defense, but will be needing KYC analysts. We'll be needing you and I, so you and I we are the first line of defense to defend the economy from these criminal, actors, from these actors. Okay, so we are the first line of defense in response to money laundering, terrorist finance, and the play and we play a critical role in protecting the United Kingdom economy from being exploited by malicious actors. And that's what we've said earlier. And we have different regulatory bodies. We have the FCA, we have the FATF, we have different regulatory bodies, that regulate different. So we're going to we are going to go into regulatory bodies so I can explain, give you who or what the regulatory body is. I'm sure we know this, but just a background, like I said. So the government has continued to remain committed, to strengthening and improving, UK regimes when it comes to, financial crime prevention or financial crime, combating financial crime. So, and KYC is one of the financial crime compliance, hence why KYC role is very important. So as a KYC analyst, your role is very, very, very important. So let's look at regulatory bodies. A regulatory body is an organization, or a regulatory body is a public or government agency created to oversee specific industries and practices. So for every industry in the UK, there is a regulatory body or agency that regulates what happens. They regulate the standards. They regulate to ensure that there is consistency in the way they operate, whether Zenith Bank or Oceanic Bank or UB or whatever, the interest rate and everything has to be consistent. They have to be the same. It's not like, I'm sorry to say this, it's not like back home in Nigeria where, what's it called? A supermarket is selling a bottle of water 200 naira and another one is selling for 500 naira. No, so these regulatory bodies, there are regulatory bodies for different industries. So within the financial institution, the financial service industry, there are regulatory bodies, different regulatory bodies that regulate different areas, even within the financial service industry. Whether it's within corporate trading, marketing, commercial banking, whatever, there are different regulators that regulate and ensure that those industries, those businesses that operate within that industries meet the standards, they meet the standards of that the regulatory bodies have laid. All the requirements and measures that they have laid down must be met. So for it to be met, for government, for the agency, for us, even as individuals, to know that all of these things that the relationship that we're having, we are safe to have those. So that is the reason why the regulatory bodies are there, to ensure that there is, fair trade, there is, all of those things are correctly met. And any business that does not meet this requirement or standards faces, consequences. So that's why they don't want to face the businesses, banks, they don't like to face, the wrath of these regulatory bodies. So, but generally in the United Kingdom, there are 90 regulatory bodies, in the United Kingdom. And examples for different sectors, we have the building, we have home, we have different sectors, charity organization. There are different regulatory bodies that regulate, that monitor, that supervises the the operations within these industries. So for the United Kingdom, we have, you would hear this when you open an account, you see it within the the small print. It will be there that they are regulated under the FCA. So FCA is Financial Conduct Authority. So the Financial Conduct Authority regulates the financial services industries in the UK. So its role includes protecting customers, that is you and I, or your business and my business, and keeping the industry stable, keeping it stable. So we don't rush to Barclays because Barclays has, no, everything is, there are just few things that, so everything has to be stable. It has to be consistent. So with the help of this regulatory body. So its role is to, it includes protecting customers, keeping the industry stable, so that the giants, the big ones in the industry will not, take over, so that it would allow even the small businesses, the small banks to operate as well. Okay, so keeping the industry stable and promoting healthy competition between financial service provider. And that's what we've just mentioned. Yeah. Healthy because it's competitive. They want more customers, So it helps to keep everything regulated. And FCA, HMRC, the Gambling Commission, and 22 other professional bodies act as supervisory authorities under the POCA, that is the Proceeds of Criminal Act 2002, okay, and the regulations. So they supervise, obviously, to ensure that proceeds of criminal acts are being reported, all of those things, they are bound, by this act as well. We have the Financial Action Task Force, and the Financial Action Task Force is an intergovernmental organization founded in 1989 on the initiative of the G7 to develop policies to combat money laundering and terrorist financing. Okay, so it usually, before, it was meant to like combat money laundering, but later on in 2001, there was another mandate and it was expanded, and the terrorist financing was included. So that was shortly after the 911 happened. Okay, so in order to conclude our background, I'm sure we are all getting this picture that I'm painting.
Mm-hmm.
Great, thank you. So we have other exposure to criminals. So it's not just events that exposes financial institutions, customers, you and I, to criminal activity. We have other exposures as well. So as we've come to understand that financial institutions, that is bank and non-banking financial institutions, can find themselves entangled in criminal activities, either as a victim, as a compliance or perpetrator, or as a tool. Okay, this is also true for individuals and businesses who are similarly, who can similarly serve as tools as well as victims as well. So you and I, our business can also be a victim or can be served as a tool for financial crime. So, but however, it is worth noting that certain businesses, so we know there are some certain businesses and in the certain individuals and even specific locations are known, of specific countries are known for, specific criminal activity. I'm going to repeat that. I'm going to explain further on that. Obviously, we know that events could happen and people will take advantage of that event. And we've mentioned like 3 events, occurrence in the past. But we also know that now that there are some group of people, when you mention them, or maybe a country, when you mention that country, and you want to think of crimes that they commit, there's a specific crime that comes to your mind. Okay, and when anyone or businesses comes from that region to have a relationship with a bank, immediately that sends a signal, because the bank knows that they are being exposed to that kind of crime from that region, from that type of business. And I'll explain further. So that's what I've said. Similarly, certain regions, certain businesses types are notorious for specific types of crimes, criminal acts. So for example, we know Nigeria. When you mention Nigeria, the first thing that comes to your mind is cybercrime, fraud. That's how they've labeled us. It's not just Nigeria. There are other countries. We have, say, for example, Afghanistan. What will come to your mind is, oh, terrorists. Especially when you remember Osama bin Laden, We know there are some businesses within the extractive industries. Okay, so like if the oil and gas industry these are extractive industry. There are lots of corruption in that industry. So specific, when someone mentioned art and antique to you, you would know that. If you don't know, I'm going to tell you there are lots of crime that goes on within art and antique as well. Okay, money laundering crime. When they say this piece of this thing was created in 1808 and they want to sell it for £1 million, okay, and people use that opportunity to move more money, funds around. So there are certain types of business that we know that it would expose the bank to this kind of crime. Okay, and like I said, but we will look more into that in subsequent. So at this point, do we have any question? Because we're going into KYC now. This is, it took us about an hour, because what I try to do as much as possible is create a background, a picture, whereby when the right information on KYC start to come in, it will be hard for you to ask, why is that happen? Why should that be happen? Because you already have a background knowledge as to why things are happening. So at this point, I don't know if you have, does anyone have any question?
No. No.
No, okay. Anybody else? There's no question?
No questions from me.
Not yet.
All right. So I think that we are all following, right?
Yeah.
All right, Grant. All right, so now let's look at the definition, the importance, and what KYC is all about. Okay, let's look at what KYC is all about. So what is KYC? I'm going to ask us a quick question here. From the past, has any of us experienced KYC? Whether you are the one that is KYC been done on, or you're doing, as I know you've not done KYC as a job, but one way or the other, have you experienced KYC, whether in Nigeria or in the UK?
Yeah, I have experienced KYC.
So what was it about? How did it go? Can you tell us?
So when you open your account, they fish for information about you. They do a lot of checks about you as well. And in my day-to-day activities as well, when you profile your customers, you do a lot of KYC, asking them about different questions on their account, where is money coming from, what are they're trying to do online as well. So that's part of KYC for me.
Okay, that's grand. That's valid. Thank you. Thank you. Anybody else? Does anybody have an account here?
Yeah, in my own experience,
Yeah.
back home, I wanted to open there's a particular account I wanted to open with Sterling Bank. They gave me a form, KYC forms, and after filling them out, they actually came to my house. And they told me they were going to come to the house to see where I'm staying. And I'm like, Are you not going too far? You're supposed to come to
You
my house.
see,
They said, "No,
yeah.
it's part of it." So they came to my house. They made sure that the address that I filled is where I'm actually living, and it corresponds with my utility bill. So I think that was when I first encountered this KYC.
Oh, I see. Yeah. Yeah. Oh, that's good. That they have to come to it must have been some sort of business account or anything.
Yes. Yeah.
Oh, okay. 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 All right. So yeah, that's KYC. So they've told you everything about KYC, but there's a lot in the UK, there's a lot more to KYC. Okay, and that's why I've merged a bit of AML, that's anti-money laundering, into KYC, because even you see a KYC analyst taking a role of an AML analyst because what they do is similar. Okay, so without wasting time, let's go into what KYC is all about. So we've scratched the surface. Now let us start to go deeper. So KYC is also known as know your customer. Know your customer. So from that phrase alone, know your customer, you know that there's more to knowing your customer. It's not just knowing your customer's name. It's not just knowing your customer's address. You have to know your customer. A bank has to know their customer at like the back of their palm. Okay. So KYC, the customer, know your customer, is the process of verifying and validating the identity of a customer. The identity of a customer is not just your name, your nationality, no. Or it goes beyond what we see as an identity, what you stand for, who you are. Okay, what makes you you? Okay, so why all that? From the background that we've checked, that we've talked about, the background that I gave earlier, you can see that it is important for, and then we'll go into the importance of KYC now. But now the KYC process, I just want to let you know, KYC is the process of verifying and validating the identity of a customer. Okay. So in other words, ensuring the customer are genuinely who they claim to be. And I'm sure that's why they came to your house, Joy. They came to your house to see, oh, does she live out there? Especially if you live on Banana Island, we want to know where she lives. This Joy, she says she lives, let's go to Banana Island and see where she lives. Do you get? So it's genuinely knowing who you, Joy, claim to be. Okay. So in the United Kingdom, the Financial Conduct Authority, that's the regulatory body that we've talked about, amongst many other regulators, or regulatory bodies worldwide, are set certain requirements and procedures for financial institutions, e.g., bank, insurers, credit providers, extra or loan providers, to follow. They've created certain procedures, requirements that these banks and every financial institutions, not just financial institutions, businesses must follow so that they can hold and have an up-to-date information about their customer and have up-to-date information about their customer. Because a customer today might say, I work with Barclays card. And then 2 years after, they've changed. They've now moved to DHL. They work with DHL. You see? So the bank needs to know, okay, that you've changed work. Oh, today I live at number 1, Rishi Sunak Way. Tomorrow, now I live at Conquerors Road. We want to know where you stay. We want to have an up-to-date information. And we want to validate that information. We want to verify that information. Okay, validating it means that making sure that this information on our own record is up to date. Okay, so this validation, verification, and all that, bringing up to date, they are part of the requirements that the FCA has laid for the banks, for financial institutions to meet. And we have to meet that standard. We can't go less. We can't, as a bank, go below that standard. Okay? So by law, KYC is required for all financial institutions to establish the legitimacy of a customer's identity and to identify the risk factors that comes with that customer. Okay, remember I said some regions has a notorious, significant, they know that this region and this kind of crime. So when they see someone come from that region, they need to, their heart of, they need to first wear their cautious heart, like, oh, I just hope this person is not coming to use this account as fraud. It's not like we will be thinking that, but I'm just saying, okay? So to identify risk factors. So these KYC requirements and procedures help protect financial institutions against, obviously, money laundering, financial fraud, terrorist financing, and many other financial crimes, related crimes. So why is KYC important? Why is it important? Why is KYC important? So the first one is to know who our customer is. I mean, why is it important for the bank? Even let's say there are no regulatory bodies. Won't we know who we are dealing with? Even as a business, if you have businesses, I know some of us might have businesses, we want to know who our customer is, who we are selling to, where the money that they are paying us, where is that money coming from? So we want to know our customer. 2, KYC is important as it prevents financial crime. It prevents who? The customers, the bank, the business, whoever from financial crime. 3, to fulfill the bank's obligation to the regulatory bodies. So it is important that we do it. So doing it helps us fulfill that requirement that's been laid by regulatory bodies like the FCA. So we have more importance, which I like to touch on. So KYC is important as it prevents financial institutions from being used by criminals for money laundering activities. We said banks can become a victim, can be this and that, can be used as an instrument or be part of it, okay? Let me illustrate that. So if we know the person that owns this account, we have the details of that person. We have the address. We have where he works. We know that the money that comes into his account is a salary or a salary. We know that this person is a national of United Kingdom. We know that this person's business, if they have a business, the nature of business is teaching. We know that, we know all these things about this person. So if the account of this person is now used for fraud or anything, first we want to check, is this person, or maybe we see on the news that, oh, Mr. ABC John Doe has committed a crime. We want to first check against the record that we hold for that person within our systems. Is that the same person? How are we able to differentiate if we don't have the full details, the record, or if we don't know our customer? We won't be able to assert that if this client that is different from the criminal. So the essence of KYC is to prevent. So, but because I know that the bank has all the information about me, it will be hard for me to want to use my account for fraudulent activity, for fraud. So it would prevent the financial institutions from being, used by the by criminals for money laundering activities or any other crime. I'm not saying it still doesn't happen, okay? But it prevents. So the KYC measure prevents money laundering from happening. So another thing important is failure to comply with KYC regulatory requirements, or there's a breach in our regulatory, KYC standard, okay, or maybe KYC hasn't been taken serious. There are serious consequences, such as fine. The bank can be fined. Okay, we've seen on the news banks being fined, financial institutions being fined, businesses being fined. Why? Because they've failed in their KYC, standards. And they could be sanctioned. No bank, no financial institutions want to be sanctioned. They don't want their license to be withdrawn. So there are consequences like that. And all these consequences, you see, if they have been fined or they have been sanctioned, damages their reputation. Okay? It damages their reputation. It damages a reputation, their reputations. Okay? So it damages not just the reputation, but their credibility. When you hear that let's say a bank has been fined for money laundering activity that they could not detect, won't you withdraw your money from that bank? Because if it was your money, oh mommy, I will cry. You get. So we would want to, because the credibility it would take a long time to build that credibility back. And financial institutions must be increasingly proactive and vigilant in their daily operations. What their staff does in the operation with their clients, their transactions with any client, the relationship with clients and customers, and why KYC and AML compliance is important, because of they just have to. So, like I said to Ada yesterday, KYC is not a sprint. It's not something that they will do. As long as there's a customer and we want to continue to retain, we want to continue to get an up-to-date information of that client, of that business, okay, KYC analyst remains relevant. Okay, and I'll still show you why and how. So, we've been saying customers. Customers. Who are the customers? Okay, who are these customers? So customers can also, so if in this training, I say clients, I say customers, they're the same, okay? And when I say financial institutions, so just in my head, I'm saying banks, okay? So just for your information, okay? So who are these customers? Customers can also be called clients, okay? And they may be new to a bank, or they may be existing customers or clients of that bank. Okay, they may be new, like the person that visited Joy, because Joy might be a customer of that Stanley Bank, but because she wants to have access to a new product, she's a new customer in that department. Okay, so Joy is an existing customer of that bank. However, on that product is a new, so there are new customers and they are new. So we might be new to a product or to the bank itself, or you might be an existing customer on that product or in that bank. Okay. So, and there are the two types of customers. So there are individual customers. So that is, it could be a person and it could be a joint account. Okay, so when I mean joint, it doesn't have to be man and wife. It could be a group of people. Okay, it could be a group of people. And then we have entities. So we have entities that profit financially, entity that doesn't, non-profit organization. So in any entity, we know somebody must be behind that entity. Okay, so the entity is a customer. Okay, the individual is a customer. I'm going to dissect that properly. As time goes on during the training, you get clarity on this. Okay, but as it is, we have two types of customers. We have the new customers and we have existing customers. And we have individual and we have entities. Entities, when I say entities, it could be businesses, companies, organizations, trust, it could be anything. Okay, so we have different types of entities. We have the public listed companies and the regulated entities. We know these type of entities, the ones that they have their shares publicly, out there for you to buy shares. We have private limited company, the one you and I have, okay? That like the Joy Limited. So we have partnerships where 2 or 3 more people come together to start a business, okay? We have pension schemes. These are entities, with that nest pension that you have, with that organization that owns that nest, we have different pension schemes, Aviva and all that. We have charity organizations. We have trust. Okay, trust is where I think the example I always give is, so I have a son, I have this wealth, money, and I say, okay, I want some people, a group of people or someone to manage that wealth for me for the benefit of my son. Okay, so that arrangement is called a trust. So I am the settlor, the owner of the trust. The person that manages the trust is the trustee. Okay, and the person that benefits from that trust, my son, is the beneficiary. So that's that's a trust. So we have different types of entities. So these are just a few. There's a sole trader, club and society, public sector bodies. Public sector bodies could be schools, universities, different, we have guarantors, we have different entities. There are loads of entities. Correspondent relationship type of entity, corporation, public, that different entities. Okay. So KYC on new and existing customers. So this is what we do when we have a new customer, and this is what we do when we have existing customers. So KYC is not only done when somebody wants to start a relationship with a bank. KYC is also done on customers that have been with the bank. I'll repeat that. KYC is not only done on new clients or new customers, but it is also done on existing customers. So we have the new customer that we do what is called onboarding. And then we have the existing customers that we do what is called a refresh or periodic review or remediation. I'll explain that. So for new customer, onboarding is done. And this onboarding refers to the comprehensive set of activities undertaken, like say coming to your house, Joy's house, getting an address, getting an ID card, all of these activities to familiarize a new customer with the bank's products and services. So it is the process that guarantees the due diligence that we've done our due diligence on that client. And that due diligence meets regulatory, legal, or any credit-worthy aspect. I don't know if that makes sense. I'm going to repeat myself. So this activity is, when it's done, okay, it guarantees that we've we now know this client. From a regulatory standpoint, we've met all the regulatory requirements from the regulatory bodies. Okay, from any legal standpoint that binds a client and the bank, or a business and the bank together, we've met it. Okay, from any credit standpoint, say we want to do a credit check or anything, or we want to provide any credit, so this onboarding, that is what it entails. So it just shows that completing that onboarding, we are meeting, it guarantees that we've completed our due diligence. And as part of this journey is KYC. So all of those things that we've done, that we're doing, is KYC. Getting the customer, making sure all the documents that we get for that customers, for Joy's business, yes, and meet regulatory standards. If she says she's incorporated in London, or she's running a business in Nigeria, we want to see evidences. Where is the business operating? Where is the operating, where is the owner of the business living? We want evidence. We want to see all those things. All those things, once we are able to get them, we've completed onboarding. We've met regulatory standard. We met every legal binding from, say, she's being protected, all our money or everything will be protected. We are meeting it. Okay. And then for existing clients, the refresh is done, or periodic review. So this involves banks conducting regular checks to ensure that customers' information and documentation remains valid and continue to meet regulatory requirements. So the information we got from Joy last year, sorry, Joy, that I keep that I keep using your name, but so it just helps me. I can't just resist using Joy. So I can't resist it. So Joy, so that information that we receive from you, the address, the nature of what your business does, the information that we've gathered, we want to check again in 2 years or 1 year time or 3 years time. Is your business still selling, houses? And it's not like you're now selling cars, because that has changed. There's been something that has changed in the nature of your business activity. So we need to have an up-to-date information of everything that we owed when we onboarded you. Whether your address is still the same, whether you're still in that kind of business, even as an individual, whether you are still operating, all over African countries and the UK, or maybe you've extended to Asia, we want to know. And from anti-money laundering perspective, it also involves assessing whether the customer's behavior aligns with expectations. So over the years that you've been running your account, that you've been dealing, using our bank account, and I'm just using bank account this time, we want to know if what you told us when you were filling that form is still the same, that you're still meeting that expectations, that your behavior, the money that you said will be coming in only from Nigeria, there is no money coming in from Sudan. There are no international money coming in. We want to know, because that was what you told us. When we want to see you meet, fulfill that part of the deal from your own side. So the periodic review is done to ensure that we are comfortable to continue that relationship with you. How are we going to ensure that we are comfortable if we don't check all your documents again, if we don't review, if we don't do that refresh? If there's anything you need to tell us that you've not told us, maybe you've changed the director of your business. Or maybe your secretary has stand down, has resigned, and there's a new secretary. Or maybe we need to refresh. We need to go back to it, and then we do that refresh. So those are the two types of KYC that is done on customers, on that existing or new customers. So for new customers, we do onboarding, and from existing customers, we do a refresh, or we do periodic review. Periodic review. Some businesses, some banks call it refresh. Some banks call it periodic review. Some call it remediation. Okay. All right. So, do we have any question at this point? Because if you don't have questions, I would ask questions. Remember, I said, I've not even seen your face, Joy. I've not seen your face. Okay. But hopefully, when I see you on the train, I don't know, I won't even recognize you. I'll just pass by you. You've seen my face, and if you say hello, I'll just say, I don't know you. Sorry. Okay. But I know Anita, I know Larry, I know Tope. Okay. So, but Anita, Joy and Ada, I don't know you.
After
Anyway.
the beginning.
Yeah, you're shy. But anyway, so do you have any questions? Because I've given background, I've given events, scenarios. I've given different background. We've talked about the regulatory bodies, how business can be used. We've talked about this. So, and we've talked about what KYC and the importance of KYC. Do we have any questions? If we don't, I have questions. And if you don't answer, I'll call names. Okay. So, what is KYC? I don't want Larry. I don't want Joy. So I don't want Tope. I don't want Anita. I want Ada. What is KYC?
Okay, this is a cut off. Okay, KYC is the process of verifying and validating the identity of a customer. It also means ensuring that the customers are genuinely who they claim to be.
That's grand. That's grand. So you want to be telling me that you are high level, you are special, Abby?
I think
Eh?
so.
Prove it to me. Prove it to me. I'll throw you another question now. Well, calm down. Anyway, that was really good. I wasn't expecting that, but thank you. It shows that you were listening. And I'm glad you were able to answer that the way if anybody else have, if you have any other words that you want to use to explain what KYC is, please feel free to do that, please. Anybody else?
Not to explain, but
Yeah.
kind of a question.
Okay.
Because I'd like to know what qualifies one to be a KYC analyst.
Do we need banking background to do this KYC stuff?
KYC. All right, that's a good question. I was expecting a question now. Abba. Okay, so one thing I want you to know now is KYC is not restricted to banks alone now. Other businesses, logistics, even care homes, they do KYC. Okay? Different businesses, because they need to know who their clients are. Okay, they need to have an up-to-date information of, even within the bank, KYC is done to know who their staffs are. Okay, so I'm just saying, but KYC is not limited, it's not restricted. Now, even all the businesses around, other businesses, other industries are now doing KYC. In the UK, this is something I would like to take out of this call. So I wouldn't want to, because you have this video and, you need to know your stuff. That's what and like I told you, Ada, you just need to know you need to do your research, know your stuff. And you know what? Can we take this offline? Can we take this outside the call? Because there are information within, but after your training, you can sit to take certifications. Okay, there are certifications done at ICA. But what I always tell people is, don't just buy, don't just pay for ICA certifications or CAMS certifications and, just read and then sit for the exam. I don't advise that. I always tell people, my candidates, you need someone to hold your hands, because we know in the UK, when you put out a CV and all right, let me say it this way, and you put out a CV and you have that experience, quote and unquote, okay, and you are able to confidently back it up to say that you know what you're saying, okay, and you're able to display that you know what you're doing, you know what you're saying when you are maybe at an interview, you get that job, okay, and that job, provides you with more experience. And then before you get that job, there are other things you might need to do, which I don't mind taking out of this. We'll talk about offline. Okay. But for KYC analyst or AML analyst, I would like that you have someone that will hold your hands, get you there, get you to know what it all entails. Okay. Get a job, when you get a job, do like 3 to 6 months, then you can now go for certifications. Okay, just so that it would appear on it. So whether you have a certification or not, if you are not, even if you have all the certifications in this world and you are not articulate, you won't get that job. Okay, and the good thing is, even when you get that job, you still get trained on that job. Because there are different systems, the different compliance tools that's been used. Different banks have invested in different tools. So, but in their own tools, whatever they use, in their process as well, they will train you. Okay? They'll train you and they would expect you, because you said you have that knowledge, they'll expect you to catch up. It's not like they will hold your hands as I am doing right now. Okay, so what we are doing right now is bridging that gap from you not knowing it to knowing it, and then proving to someone out there that you know what you're saying. And that's me getting you there. I hope that makes sense. And I hope that answers your question, at least for now.
Oh, yes, but academically, you have to be a graduate.
I've seen managers work in financial service industry in the UK here that only have maybe GCSE or understand. Okay, and what they build on is experience. But you have, I'm sure because in this country, experience is what matters, because they know you're bringing something to the table. Okay, your experience is what matters. So the more experience you are, the better job you get, the better your pay. Yeah, okay. So does that answer your question now, at least?
Yes, yes.
Yeah, we can take some questions offline, okay? Yeah. So I have another question. Why is KYC important? Mr. Larry, we've given 3 reasons why KYC is important, and I want someone to mention one. I want each. I want 3 people, please. Why is KYC important?
To have full understanding of the customer or the or the client you're dealing with.
Yep. To know our customer, to know them, to know who our client is. Anybody else?
Yeah, to prevent terrorism, to prevent fraud.
Yeah, to prevent fraud and money laundering, any financial crime. Yes. Yeah. Thank you, Tope.
Yes.
One more.
It's close to what she just said, to prevent banks from being used by
Yeah.
criminals for money laundering. Prevent
Yeah.
banks
So
from being used or exploited.
yes, that's also good. But that falls under yeah, what she said, for prevent from, yeah. So there's one last one.
The bank needs to save their head too from the consequence of breaching the regulatory requirements.
Yeah. I
And
like the way you, yeah, and that is fulfilling, yeah, regulatory obligation. Yes, yes, that's the last one. So they need to save their heads. They need to prove to the regulators that they are doing their KYC. And that is, yeah, that's it. So those are the three importance of KYC. So now I want us to look at, we've been mentioning financial crime. We've talked about financial crime, different, we've been, picking here and there. We've talked about financial crime. Somebody mentioned terrorist financing. Someone mentioned fraud, this, that, that, that. But I want us to have a quick look at financial crime. That word, financial crime. What is financial crime? What is financial crime? What is financial crime? Can you still see my screen?
Yes.
Okay, brilliant. So financial crime, you might see it elsewhere, written as economic crime, that it means the same. So financial crime is also known as economic crime. And this refers to illegal acts committed by an individual or a group of individuals to obtain financial advantage. It's just as simple as that. Whatever they do to obtain financial advantage. Okay. So in other words, it's everything illegal done, criminally done, in order to gain, to be at a, to have financial benefit or to get financial gains. And the principal motive from that definition is economic gain, financial gain. That's the essence. Okay. So anybody that wants to commit crime, cyber crime, or anything, the first thing is what they will get from it. And that is financial gain. Money, 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 money. Even the Bible is not wrong. So, but let's look at the common financial crimes that we see out there. So we have a few, but before I start to display any, is there anyone want to mention any one or two? Apart from fraud and money laundering or terrorist financing that we've mentioned, any other one that you can think of? Hello?
Any other financial crime?
Yeah, that you can think of.
So in the application fraud.
It's still fraud.
Okay, still fraud. Okay.
Yeah.
Whether online or
Yeah, whether online is still fraud.
corruption.
Corruption, yes.
Oh, it's part of
Right.
it.
Yes, corruption is a financial crime. Bribery and corruption, actually. Did you say anything, Ada?
I said kidnapping, uncle.
Kidnapping is a financial, it's because obviously it's for financial gain.
Financial gain.
Yeah, it's for financial gain. All right, I'll thank you. Yeah, thank you. But let's look at this. So we have identity theft. Identity theft. So identity theft is the fraudulent practice of using another person's name and personal information to obtain credit, loan, for financial gain. So people steal people's identity for financial gain. Okay. They impersonate. Okay. We have tax evasion. So this is deliberately misrepresenting or hiding information to reduce the amount of tax payable or avoid paying at all. So a lot of people, a lot of businesses, you can see at some point, I don't know if we've heard of Donald Trump being, charged for, tax evasion. Even people in high places, they get charged for tax evasion. So tax evasion is a financial crime. Okay, we have human trafficking. So I think kidnapping would fall under that, human trafficking. So, there's kidnapping I think it should be separated. Kidnapping is when you take someone hostage and then for demand for money, but human trafficking involves the recruitment or movement of people for exploitation using threats, force, or the abuse of their vulnerability. Trafficking, you can move people from one border to another border, from one country, even all these house girls that we get from from Benin Republic, they come, they are trafficking in one way or the other. You see people move women, they say, oh, want to send you to Italy to go and work, and then they start using them from prostitution. This is human trafficking as well. Okay, because they use them for financial gain. They use their vulnerability. Sometimes they use threat or force on them. So trafficking is a crime that can occur across international borders or within a country. So we have the famous terrorist financing. So this is the provision of funds or including assets or providing financial support to individual terrorists or non-state actors. So people that does not support the government or, so the government of the day, they are, they use terrorism to frustrate the government. So terrorist financing does not have to be for financial gain, and it often involves legitimate financial proceeds as well. You see that some people, businessmen, people, in good places, they make their money legitimately because of the interest, or maybe conflict of interest, or maybe because they don't support the government, they will support terrorism so that they can frustrate. So it doesn't mean that the money will come from illegal activity. It can come from a legit business. So that's why we need to be very, very conscious, because you see money move out, it might not be for the purpose of business alone. Okay, so that is terrorist financing. We have fraud, which we have been mentioning, is when a person is financially cheated by another, or it doesn't have to be a person. When a bank is when you do application fraud, you're trying to defraud the bank. So fraud occurs when an individual deceives another or a business or a bank by inducing them to do something or not to do something that results in financial loss. So we have bribery, like Adam mentioned, we have bribery and corruption. So it's is dishonest or fraudulent conduct by those in power. It doesn't have to be those in power alone. Those we can see even on our street of Lagos. Let's just use that as an example. You see the police, because he wants to collect something. It's bribery. It's not good. Even bribery in a corporate level. There's a corporate bribery as well, where you see businesses lobbying for government contract, and then they have to pay certain people within its bribery, it's corporate bribery. Some businesses, like all this oil company, because they want to extract, a natural resource from somewhere, they'll pay, people in power so that they can influence their interest for the gain of themselves. Not, you understand? And then they portray on television that they want to extract for the benefits of, the country or the community. There are different ways to bribery and corruption. Okay. So bribery is offering, giving, or receiving anything of value with the intention to inducing a person or a group of people or even the government to act or to reward a person for having acted. We have money laundering. So money laundering is the process of washing or cleaning illegal money. Okay? So what we want to do today, we'll be focusing on money laundering and KYC. Money laundering and KYC. So, because we know that one way or the other, all the proceeds from all the funds that goes into terrorist financing or fraud, okay, will pass through, a lot of them pass through the bank that we work with, okay? And you see people, they want to conceal the source of that money because nobody would tell me that the money that is coming into my account is, I got bribed and I want to pay the money into my account. Nobody would do that. Or nobody will say, oh no, I just moved some people to Italy. They've been paying me. So I want to, nobody will say that, obviously. So they tend to, so all these funds, they are going to be ways to conceal the source of these funds. Hence why we'll be focusing on money laundering, because that's money laundering itself. Okay. So what is money laundering? Let's look at this closely. So money laundering is the process of washing or cleaning illegal money. That is the process of making, money that was generated from criminal activities, whether from drug trafficking, human trafficking, terrorist funding, to appear as if it came from a legitimate source. Okay, so all the money that they've made, the criminal has made, he has to put it somewhere. You can see some people who store the money in their house. Some are bold enough to take it, to put it in their account. Okay, but concealing the source of that money is money laundering. Okay, so the money from these criminal activities is considered dirty. And the process, launder, is to make it look clean. So that money is dirty, okay? And for it to be whatever, put into account or be used to make so that people will not know that, oh, I just defrauded someone now, okay? That process is laundering, okay? It's to make it look clean. When you wash something, to make it look clean. That's why that 20 euro is being spread on that line. Okay, so let's look closely into money laundering. So there are 3 stages of money laundering. You see, criminals, they have that 3 stages. There's that 3 stages for this to have gotten to this point where the businesses or the regulatory bodies, they've studied, or people that have put these processes together, requirements together, they've studied it, and they already can confirm to you that these are the 3 stages of money laundering. There are 3 stages. So the first stage is placement. The first stage is placement. Okay. Pardon me. So the first stage is placement. This is where the dirty money is injected into a legitimate financial system. A legitimate financial system could be a business, could be into an account or a business account or into a business. That is, you're putting it into money that's not clean into a business, into a legitimate financial system. Are we following? Into a legitimate financial system. And then the second stage is layering. So layering is creating an apparent legal origin for financial proceeds. That is, that fund is now transferred, maybe from one business account to another, including maybe offshore accounts, And then they start to do one nonsense bookkeeping, those measures are ways of layering and covering the tracks, concealing the tracks of that money. And then integration, this is where the money is then disbursed, from those accounts or from that particular account, to be used to, for their personal benefit. Some can put the funds into, say, they can use it to buy shares, some into invest in properties, cars, luxurious, luxury cars, they now put that funds into different places. So that when they ask them where, say, I want to buy a house, they say the money came from the business. Because remember, they've laid it, and then they will present some sort of annual report, some sort of bookkeeping memos and everything to say, oh, the money has been in there, so that will reflect that the money has been in their business. And remember, they already placed the money, that's placement, into that system. So those are the 3 layers. So I have an example here. So let's say that cash has been earned from illegal, from maybe drug dealing, selling drugs, and the owner of those, the drug dealer has a car wash, okay? And he wishes to buy a new car, okay? Or maybe he has a laundromat, okay? And he wishes to buy a new car. Do you think he would carry that money, the drug money, this one that has dirty notes, new notes? He can't carry the money to the car dealer. So first thing first, because he knows that he will raise suspicion, So the first thing first is he will put the money in small crunch into his account, into the business account. That's the laundromat account. That is the person placing the money into the financial system. And we know that if you own a laundromat, they operate in cash. They are cash intensive business. So they put this funds into the laundromat. And then this fund is now, mingled with the money from the laundromat, and then is deposited into the bank. So when they go to deposit funds as usual into the account, the bank already know that this is a laundromat and they bring cash. So they will just be increasing the cash in crunch. It can take time so that the bank will not detect. So they mix the money with legitimate money. And then they can now draw a check on the laundromat account, say to buy car, or withdraw or transfer money from the laundromat to buy car of their choice. Okay, some people, they go to casino. Once they've gotten this, they go to casino to go and play, to gamble. They will not finish the money. They can just gamble, maybe they brought in 50,000 pounds. They can gamble 1,000, 2,000 pounds. They don't mind losing the incentive. And then they will now take all, when you go to gamble, you buy all these seeds, all these, I don't know what it's called, all those red, blue seeds that they move, What was that, Larry?
Chips. It's called chips.
Chips, yeah, chips. So they buy all these chips, and then they take it back to the counter. And obviously they won't give them cash. They'll rather draw a check or do maybe process funds that will be maybe like 3 to 5, okay, but they would not collect cash. Okay, so some would, or maybe some would, they'll offer, but some will say they should draw a check or something, and then they take that to the bank as if they won. It's not illegal to win from gambling. Okay, but they've covered the track of that money. So they've concealed the source, the origin of that criminal process. So those are the 3 stages of money laundering. So, and then we have anti-money laundering. Okay, so we've talked about KYC, and we're talking about. So this is this is the surface. You see. So what is anti-money laundering? So anti-money laundering is the set of laws or regulations or procedures designed to prevent criminals from disguising those dirty money, those illegal money for illegal funds that has been obtained from their illegal acts, the proceeds, so that they don't disguise it as if it came from a legitimate income. So there are processes that have been put in place that you and I, as an analyst, will need to follow. We need to know, so that when we are looking at the activities that's happening on this customer, we know, we can tell, it will prompt us, it will prompt the right questions to the client. Okay? It will prompt the right questions to the client. All right, so the process involves financial institutions actively monitoring and reporting any suspicious activity, because we would not be in position to say, oh, you are a fraud, this customer is a fraud, or this customer is a terrorist. Okay, we won't say that. But there is a right, agency, the right agency that would take that over on once we are able to suspect any activity that does not just add up. Okay, so, and what are the measures that we that is involved in anti-money laundering? Okay, the measures, the first one is KYC. You can see that KYC and AML are intertwined. They are together. So that is, the information that we collect, validating that information. Because if that information are not valid, if they are not validated, they're not up to date, or they are fake information, we have missed someone that would, okay. We have missed someone that, we might be missing someone that, we might be missing a criminal. I don't know if that makes sense. So we might be missing a criminal. If that criminal has, now that even people change their sex, they change their, you see men want to become a woman, things are happening in this world right now. There's AI that can build you and access your account. That's why we need to have up-to-date information about our clients, our customers. Verified documents. You can't just overlook documents that doesn't add up. You have to verify them. And then the next one is monitoring. So the bank, as in the financial institution, they have to continue to monitor, customers' transactions. That's why you see where Larry works, fraud, any alert, anything that comes on, they keep monitoring. It's a part of AML measures. Then they monitor the client's profile. What has changed? You see a client today, they will tell you they are hairdresser. I always like that example because it's funny. You see, an hairdresser that earns maybe 5,000 a month, and all of a sudden you start to see 40,000, 50,000 in their account. How are you playing air for ghosts? We need to find out what has changed in their business. So we need to continue to monitor their profile. Maybe they are not just hairdressers, or maybe the money is legitimate. But we would need to ask, because if we don't ask, we won't know. Maybe something has changed. Maybe now they now sell air supplies. So continuous monitoring. And when you say compliance, the bank must have it at the back of their mind, or it will be their goal to continue to be compliant. And if they say we are not going to meet up with compliance this year, they might miss it. They will chop cane. I'm sorry to use that, to say that. So bank have to be compliant. So they have to continue to train their staff to ensure, you know, all this my learning and everything. They need to be aware of what's going on. Bank, when they say monitoring risk, we continue to monitor the risk. You remember we talked about every region comes with their own risk. Every individual, when they see a Nigerian man, you know the stereotype, you know how they see us. I'm just saying, okay? And the way there's a Russian woman that I work with, okay? But she's lived here, forgive me, but I'm just going to say, but you know, it just, when I say, I just remember some things, which is wrong, although, but it's just the way we are programmed as humans. Okay, so as a bank, we need to continue to assess those risks and monitor to ensure that those risks are still being mitigated. No new risk has been developed. No new or adverse, development has happened. The operations, the bank needs to continue to monitor its operations as well. And also our exposure to sanction. Is this customer being sanctioned? Customer yesterday might not be sanctioned. Today might be sanctioned. Like the other day, the news comms was circulated at my workplace, and someone that's been sanctioned used, this wise, I don't know, money transfer or something and maybe he has a card or something. He withdrew 250 pounds from ATM, and this person it was tracked. It was, and immediately, imagine that wise investment, or I don't know, they got fined. I don't know if they are still in court right now, or maybe because for that alone, their license might be withdrawn. So we continue to monitor any exposure against any negative news. Maybe we just hear that, oh, Mr. John Doe of Barclays Bank or something, of ABC Bank defrauded or did tax evasion. They did tax evasion or something. That was charges on them, and we don't know. We need to know. We need to assess that information. The negative information is a negative information about that customer or about the business. We need to assess that information and to ensure that on a risk-based approach, are we okay to continue relationship with this type of person? And lastly, there's what we call PEP. PEP is a politically exposed persons. So politically exposed persons and their relative or their close associates. Boris Johnson is a politically exposed person. Those kind of people, they carry a lot of risk. Why? Because of their level of influence in the society. Dangote is a politically exposed person. Tinubu is a politically exposed person. And remember, note that politically exposed person does not have to be in a political office. It might be a level in a government sector or in a well-known investment or a public figure. Not just all this Yabo Joe public figure. But you get what I mean?
Oh my God.
So, but it has to be, that's a PEP. So, but before we go into the proper KYC AML which we're going to start in the next training, I still want to go deeper into some information that I feel like it will be very, very useful to you. Okay. So once we suspect anything Remember, when we continue to do our monitoring and everything, and we suspect anything, we raise what is called a SAR. A SAR is a suspicious activity report. Suspicious activity report. Larry, I know you'll be familiar with this, a suspicious activity report. So what is a SAR? So a SAR is a suspicious activity report, that is a piece of information which alerts the law enforcement that a certain client or a certain individual or a certain customer, okay, that their activity is in some way suspicious and might indicate financial crime. It could be money laundering, terrorist financing. Maybe you've been suspecting that your neighbor can raise a SAR on you if they feel like, in this neighborhood, you brought in Lamborghini yesterday, a month after, you know, and they don't feel comfortable, they'll raise a SAR. It is now left to the right agency, the agency that the SAR goes to, that is the NCA, to investigate you, and they can say, oh yeah, you are a crime, I mean, you are a criminal, you are, you know, but a SAR can be raised in anywhere, anyone can raise a SAR, okay? And raising a SAR, we'll get to that. So submitting a SAR provides the law enforcement with valuable information to put on a potential criminality. It also protects you, your organization, even the UK financial institution, from the risk of laundering the proceeds of criminal acts. Because obviously, if someone is into criminal activity and they are bringing cars and you're not, if you call this, if you raise a SAR on them and they investigate and find out that, oh, this person is involved in, you know, so it helps the bank, even you and I, or the victim, you know, it prevents them from that continue to happen, from, you know, laundering that proceeds of that criminal process for criminal activities. You know, people launder money in different ways. They can launder money, when we said layering, they can disburse money, use LEMFI to transfer money to Nigeria, to Ghana, anywhere, so that the money will not, you know, there are ways. So by submitting a SAR to the NCA, the National Crime Agency, you are complying with any potential obligations you have under the POCA. That's the Proceeds of Criminal Act. Remember, when we're talking about regulatory body, I told you that the FCA and the HM Revenue and the Gambling Commission with 22 others are bound, you know, by this POCA, Proceeds of Criminal Act. So they by you even doing it, you are fulfilling that obligation, because everybody has that. You need to. So when submitting a SAR, because you might get a job that you might need to raise a SAR, okay? Excuse me. When submitting a SAR, the explicit rationale behind the reason for suspicion and the context of why that SAR is being submitted should be clearly communicated in simple English. Don't go and be blowing grammar like that guy in Nigeria that say Laboseto Ketabarisha. Don't blow grammar. Just put simple English. This person's money came in from this, and we've asked questions, but they did not give reasonable, as in reasonable excuse, or, you know, commentary or something, information that, you know, so the NC will now look for that. So your structured report, it has to be in a logical format, the relevant information, that's the name of the person, the account, the amount, how long it has been, and all that. Everything you notice just have to be there. After this training, I'll be sending us a guide on how to raise SAR and everything that needs to be in the SAR. Okay. Even if you go on LinkedIn job, you see that there are some jobs that just say SAR analyst, SAR, all you just do is you come there to work, you review a SAR that has been raised, and there are process and procedures for every bank. Okay. All right. So that's that about SAR. So when you notice when there's a suspicious activity that we've discovered through monitoring, we have to raise a SAR. Okay, and SAR, you have to raise it within, I think, 48 hours or 24 hours or 72 hours. I can't remember, but you have to raise it immediately. Okay, there are other crimes that's, apart from financial crime, that you and I might commit. And we have to be very, very careful. We might do it unknowingly. We might do it as a victim of, we can be an instrument. So, but other crimes. So crimes that could be committed by you or any internally include tipping off. So say, for example, you notice anything, you suspect anything, and you want to call the client you don't call the client to tell the client, yes, we notice, I think that money is not legal. Can you prove to me that no, you don't say that. You're tipping the client off. You don't say anything that will that will raise anything within the mind that it will suspect that, oh, I think I've been investigated. Once you do that, that's tipping off. It's a crime. It's a crime. So if you get on a job and on that job, you are required to do a client contact. That means you need to contact a client. Please note this. Whatever you're investigating, if you're in that position that you have to look at something, you don't tip off. You don't tip off. Be friendly. Be FBI. You don't tip off. And then if you notice anything and you say, no, I think it's usual, and you don't report it, whether it's minute or it's big or, you have to report it. Failing to report is a crime. And also, this is one thing that I know even back in Africa, well, from that I know, it happens. A lot of time, you see, they conceal the source of funds. When the funds comes in and you are not investigating it, or you're not reviewing that funds and you ignore the funds, and you say you say that means you are concealing something on that funds. Okay, for you not talking or looking into it is concealing the source of that fund, and that is a crime. So apart from the monetary fine that you might get as an analyst or the bank might get, there are other consequences such as license being withdrawn for the bank and imprisonment of individuals involved. You can be blacklisted and you may not be able to work within the financial service industry. It might be hard to even get a job because of, that credibility. Okay. So just a quick note so that we know the gravity of what we're getting into. So today's most common financial crimes are terrorist financing, money laundering, blah, 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 all that. And in the UK, the most, the common fraud is fraud. Common financial crime is fraud. So this is, remember I even mentioned one that they defrauded telecommunications for almost 400,000 pounds. So this is where criminals use stolen cards, credit cards, debit cards, details. In fact, like about last month, I was in Bromley and I wanted to bring out my phone from my pocket. And I needed to pay for bus pass. For some reason, I don't know, the card fell off and I didn't notice. And then when I got to work and I just noticed a notification. Someone wants to buy something at Greg's with my own card. I mean, it was really funny. You need to see me on the call. So, yeah, so they use card details, even the details on the card to buy something online over the phone or through mail order. So this remains the biggest category of loss. So in 2022, it was a loss of about 395.7 million pounds in UK. And this figure is more than at our 2022 or 23, this figure was more than the previous year. So it shows that the criminals continues to find ways, to beat the system. Okay. So, and this is basically from my research and article. So KPMG cites synthetic ID fraud as the fastest growing financial crime in the United States, costing banks more than $6 billion. So 2003 is likely to see even more. Okay, so these are reviews, something from, all right, so see, with this, when I tell you there are consequences, this is NatWest. NatWest was fined 264 million, and after taking deposit of laundered cash in bean bags. So we know that there's this jewelry shop, they bring cash, and they've mixed money from criminal proceeds into that money for 5 years. And the total of that money was 365 million. So the bank was fined 264. This was in 2022, December. FCA fines Ghana International Bank PLC 5.8 million for failing its anti-money laundering controls. So we've been talking about our obligations and, they investigate, they come into the bank, they tell you when they come, and then they look at your process, they look at everything. This was as a result of AML failure. You see, FCA fines Deutsche Bank 163 million. Standard Chartered latest bank punished by Watchdog as PRA fines 46.5 million, HSBC fines 64 million, Lloyds Bank fine 45.5 million. You see, these banks, they get fined, okay? They get fined. So it's real. It comes on the news. You see it on news articles and everywhere. You can just check Google. You see a lot of them, okay? So at this point, is there any question? We've talked about a lot of things here. Is there any question? We talked about KYC, what KYC is, the importance of KYC. We've talked about money laundering, anti-money laundering, different financial crime. And we've talked about, what else? We've talked about quite a number of things. So, but if you have any questions, please go for it.
Okay. Please, I would like to take you back to monitoring. When you
Okay.
talk about
Monitoring.
under
Okay.
anti-money laundering, when you talk about
Okay.
risk, how would you know that a client is or a person is a financial risk to the organization?
That's a perfect, good question. Like, it's a lovely, beautiful question, So, like I said, when I was given that background, people come with, their risk, by default. Okay. But at the same time, when we start to collect the information from them, we are going to get to that part. Okay. That's the next part, actually. But I like that you asked. So once we start to collect information from people, from this customer, the person, you've seen the product, you're interested, we want to know, we have to meet our own regulatory. So there are already parameters in place, okay, that by these regulatory bodies. Remember, there are requirements in place. if you are meeting certain requirements or not meeting certain requirements, you fall under certain threshold, you know, there are parameters, things, metrics in place that have been put in place. But only when we start as a KYC analyst, start to collect this information from these customers. What is your name? Where are you from? What's your date of birth? What does your business do? What, you know, where is your business? Where was it incorporated? You know, what's your annual, you know, all those things. That is when we start to, you know, look at the risk that comes with the through the information that we receive from these clients. I hope that answers, that makes sense to you too. Yeah. Okay. Well, we are getting to that part, okay?
Okay.
Like I said, we are not going to leave, in this training, we are not going to leave any stone untouched, okay?
Okay.
Any other question? All right. I have questions. I always have. Are you ready? If you are ready, let me see thumbs up, even if you don't want to show your face, your beautiful face. All right, Larry is ready. Anybody else? So Larry will take the first question, Anita will take the second question. If you are ready, thumbs up. If you are not ready, don't thumbs up. Anybody? You are not ready? Orijo. Okay. So Joy, you're not ready. Ada, you're not ready. Thumbs up, please. All right, so the first question here, give example of financial crime and its definition. We've mentioned a few, so give one example. I want two people to answer this. So Larry, you were ready first.
So example of financial crime.
Yeah, any example, just one, and define it or explain it. Yeah, define it. Yeah.
So identity theft.
Okay.
That happens when an individual is being able to secure a customer information or a client information and use it to apply for example, a loan or for a mortgage without the customer knowing.
That's good. That's a good one. So it's whereby the an individual identity is being stolen and then used to apply for, say, credit loans or anything like you mentioned for their benefit, for their own gain. Any other one? Any other one? Thanks, Larry.
Thank you.
I'll say the obvious one, money laundering, which is the process of cleaning fraudulently or ill-gotten money, if I put it that way, and trying to make it the process of that crime, trying to make it look clean, trying to make the money look clean. So money laundering is a part of financial crime.
Yeah. Right. That's a good one. That's a good one. Any other person? Tolu, you sent a message that you're ready. Ada, Joy. Ada, Joy. Ada, Joy.
Okay, you mentioned tax evasion.
Yep.
You mentioned
What is tax evasion?
when you don't pay your tax. When you don't pay your tax, you cover it up, you try to falsify documents just to cover up, and you don't pay you don't remit what you're supposed to remit.
Yeah, I like that word, falsify. Yeah. Thank you for that. Thank you. Ada. Crime plenty.
Okay, human trafficking.
Human trafficking.
When they move people to maybe different countries to exploit them for labor and also make money. And like you said, kidnapping is also under human trafficking because people get kidnapped and they are moved to other countries for exploitation as well.
That's a very, very good one, especially where you said for labor. Recently we had Freedom Day, Freedom Day, where even children were like, there's child labor, against child labor, Freedom Day, recently we had that. And I've come across a case where I was trying to, I was assessing the negative news on a well-known company in the world. So they get cocoa from Brazil, and on that cocoa plantation, you see it's a poor country, it's a poor, maybe town, village or something. There were children working there, and because this company, the big company, gets cocoa from there, they were being charged to court for child labor. It's not like they were directly the owner of the plantation, but because they know, okay, because they do business with this plantation, and that plantation, they should have, alerted, inform the right authorities about. So they were found, I think they were fined about $600,000 or $200 million or something. So, but yeah, it's so thanks everyone. I think there's another question here. Can you still see my screen?
Yes.
Yeah. Unfortunately, Anita has mentioned what money laundering is, but what are the 3 stages, 3 layers of money laundering?
Placement,
Okay.
layering, and integration.
So what is layering? Anybody else?
That's when you try and create a legal covering for the ill-gotten money.
Yeah. And what is placement? Anybody else? Tolu, are you there?
When money is injected into a legitimate financial system.
Yeah. So I think we are all on track. We are all on top of our games, all of us here. So let's just move on because of our time. So what is a SAR? What is SAR? What is SAR? I don't want Larry. I don't want Larry. I want someone else. I don't want Anita.
Suspicious activity reports.
Okay, what is it? What is that report?
It's an information that alerts the law enforcement that a certain person or client or group, they have some kind of suspicious activity
going on, yeah.
And you said that you can raise on your neighbor. If your neighbor is a Yahoo boy and you notice.
Why are you saying it?
I didn't say Yahoo boy. I didn't say Yahoo boy. I didn't say Yahoo boy, but I can't see you. But I want you to clap for yourself, like
Thank you.
This Odogu. Call yourself Odogu 3 times. I want to hear Odogu. But yeah, that's a good one. In fact, you should take over this class. All right, so yes, let's move on. The question you asked, Joy, about how would we know if if there's a risk or something. Okay, this is how we would know. We are there now. That's what we call customer risk assessment. And once I want to tell us about this and what we're looking at, and then the next topic would be our key risk indicators. So, but first, I want us to look at customer risk assessment. Customers risk assessment. So even as a KYC analyst, before anything, before you, as an AML analyst, before anything, the first thing you look at is the level of risk of this client, of this customer. The first thing you have to carry out a CRA, which is a customer risk assessment on that client. So, and this is a process that analyzes a business risk of exposure. That is the bank's risk of exposure to financial crime. You remember we said region, some kind of business, and I made mention of, say, oil and gas, the extractive industry. They are corrupt because, they are not, maybe even the real estate. Okay, the developer, there are different risks that comes with every type of business, even the nature of business. Mining has its own risk. Even antique, and it has its own risk. Engineering has their own risk. Okay, there's a risk associated to everything that we do in life. Stepping out of your house, there's a risk. Okay, so I'm just joking. But anyway, the bank knows that once they start a relationship with you, they are exposed to that risk. I'll repeat that. Once the bank starts a relationship with any client, they are exposed to the risk the client is bringing to the bank. To the relationship. So anyone that walks into the bank, or any business that comes into the bank, or into whether bank or non-banking organization, that wants to start a relationship with a financial institution is coming with the risk, and the financial institutions know instantly that they are going to be exposed to this risk. Okay, that's why they have to carry out an assessment. They are not going to say, because you are bringing risk, we won't have a relationship with you. But what they can do is assess the risk that you're bringing, okay, and see how they take it from there. And that is where you and I also, where we become relevant. So this process aims to identify which aspect of the business is put at risk of exposure to any financial crime. Okay, the bank achieves this by monitoring and assessing known vulnerabilities. Obviously, when someone comes to a business comes from Nigeria, for example, I keep using Nigeria because we can always relate, all of us on this group. And we know that the bank knows their vulnerability, because anyone that's coming from Nigeria, obviously they can falsify documents. They can even call the person that will verify that document in the CAC or or whatever in Nigeria that they are going to call you from Barclays Banco. And they know that, but they are ready for whatever risk that comes. Okay, and that their vulnerabilities have been categorized. They know these areas of vulnerability. They know, so they've categorized this into 5 different categories, and they all fall under their risk. So these are called the key risk indicators. So the things that first their mind they look at when they want to assess any customer, when they want to onboard any customer, when they want to have a relationship with any customer. So they've analyzed these and categorized these into 5 different, so that it will be easier for them to, walk around. Okay, but let's look at, on a practical level, the risk assessment, how it helps the business. First, it is used, the risk assessment use a risk-based approach. The bank use a risk-based approach, to identifying and preventing, obviously, money. So because they've known this risk, they are looking at it, they can now say, okay, on a risk-based approach, and then they can now go ahead with whether the business or not. So it would then prevent them from any risk of money laundering that's coming in or anything. So understand the risk associated with various business relationship and commercial. So the risk assessment would help them understand, various risks that comes, because every customer is peculiar. You do come with different risk. If a director in your business is not from Sudan, okay, your business operation might be to, say, excuse me, India or Mexico or Ukraine, you know, there's something. If one thing is not, you know, something would, and we know different, excuse me, region with their notorious, you know, crimes, activities. So it will help create policies, procedures, and controls that actively reduce the risk of financial crime. Because obviously, anyone that is onboarding this client have to follow all these processes and procedures so that they know that once these are being followed, it would help them, you know, mitigate any risk. You know, it helps them make more informed decisions about their employees and their clients as well. The employees in the sense that how they operate and how they, you know, maybe their relationship manager, it helps them make, if they are being, you know, if they are being caught up in part of the anything that is going to come, or, you know, the risk assessment, customer risk assessment helps the banks a lot. And it helps in identifying, you know, any transaction and any relationship that involves an or at risk of sanctions country. So because they are being laid down, categorized KRIs, that's the key risk indicators, it helps us to be able to immediately identify that, all right, if we have a client and the client says, oh, they are into oil and their main customer is from, say, let me think of, let's say from Saudi Arabia or Russia, okay? Immediately, we know that transactions will be coming in from these locations into this relationship, okay? And some of these countries are sanctioned. Some of businesses in those countries are sanctioned. So it will help the bank to be able to identify that, okay, if your this is coming, to assess and identify, you know, all the expectation obviously that we want, that we are looking at for the client. So it will help the bank to know that, oh, this is a no-go area. We don't want a relationship with a sanctioned country, a sanctioned individual, whatever. Or maybe if we assess the sanctioned business and the country and business, some will say, oh no, the only relationship they have with a sanctioned country is they provide aid. So like 1%, less than 1% of their revenue goes into that for charity or anything. And then, yeah, that's fine. So it helps to, you know, identify the risk there. And it helps to, you know, evaluate the risk and, you know, the reduction, measures to reduce, you know, this risk. So these measures are an essential part of any anti-money laundering compliance program and can help organizations stay in the right side of the law. Okay, so we don't want to be, you know, fined. We don't want to be, you know, and all that. So assessing the risk would help. These are the practical benefits of assessing every customer's risk, because the same customer is not, like I gave an example that when an oil company is transferring 100 million and a charity organization is transferring the same 100 million, I will raise eyebrow to the charity organization because I know oil company would do big money. But charity organization, who is your donor? Maybe that donor is trying to hide proceeds from crime. So it might be that, so the question would now say, if you're coming to on board and I ask you, how much are we looking to, and you say like 100 million, I will say, who are the donors? Where's the money coming from? These are the questions I want to see, I want to know about. Okay. So these are the benefits of, you know, customer risk indicators. So now let's look at the key risk factors, you know, the key risk factors. So businesses Bear with me. So businesses, as is financial institutions, can perform a risk assessment on their customers by examining crucial risk indicators. That's the CRA, that's the process, that's CRA. These indicators are divided into 5 main categories, and that should be evaluated by the business, by the bank. So the first one is, the first category is the size of the business. Obviously, you know, if there's only one director in a business, it's just a limited company, compared to a company that operates globally or that operates in more than 5 countries. So when I say jurisdictions, I mean countries or region or geographical location. They're all the same thing. So, or in different jurisdictions, and they have directors there, they have directors here, okay? They have, you know, that business is big. So obviously the risk that they carry will be big compared to this one that I know that is just Mr. Bimbola that is the director, is not the, you understand? So because we know that their revenue, even the annual income, the annual turnover for that big business it might be more than the, you know, where we just have a single, you understand? So the size of the company, the size of the business, that is also is a key risk factor to look into. The nature of the business as well. The nature of the business, what the business does. Okay, the nature of the business would include what they do, the activities they do, that is, what they sell, what they buy, who they sell to, who their customers are, the jurisdiction, the location of their customers, where they operate, okay, whether they have online presence or not, the location, maybe their registered address is different from their trading address. All of this information are within the nature of business. That's the nature of that business. So the nature of that business determines if the business operates in firearms. We know that this risk, I'm sorry to put, so we know that this risk, the risk, you know, a business that deals with firearms, the risk will be high because terrorists can patronize them, or they can be, you know, if let's say we have a charity organization, okay, oil and gas. We know in that industry, in that business, that type of business, there is evidence, there might be an element of corruption. Okay, real estate, and so on. Pharmaceutical industries. Do they use the right medication? You know, all of those things comes with risk. The nature of business is key as well. Or the nature of your occupation, if it's an individual customers and not an entity. Okay. And then the complexity of the owner of the ownership of the, you know, business. So let's say this business is owned by another limited company, and that limited company is owned by a trust, and that trust is owned by an holding company. You see that all of these business is owned by this. Who owns it? Who is that individual behind it? Did all these business start themselves? No. So we need to find out, because it becomes complex to now first look at the business A, business B, business C, and then business D. It is complex. It becomes unnecessarily complicated. So that alone is a risk, because in KYC AML, we have to know the owner, the natural owner of that business. The natural owner of that business. And then the next one is geographical location. Okay, so this is a factor. In this factor, like I said, the business might be incorporated in, say, Cayman Island is no longer, might be relocated, it might be incorporated in, say, Brazil, Nigeria, Sudan, Afghanistan, anywhere. Okay, that we know that this region Remember what we talked about our background, okay? Or the director or the UBO, that's the beneficial owner of that business, resides in a location that we know that is, I mean, the risk there is high. Okay, or maybe the business operates or receive transactions from that jurisdiction. So jurisdiction is a key, risk factor that the business will also look at. Where is their money? Is this money coming from? Where is it going to? Where does the representative, the related parties of this business, where do they reside? I'm sorry I've not given us our break because of our time. And then the type of customer that is connected to that business, or the individual that is, whether the individual is high net worth individual. We know high net worth people, individual, or high net worth person or comes with all this big money. A PEP, we mentioned the PEP earlier, politically exposed person. Okay, the type of people, or maybe an MSB. MSB is money service business. You see all this lengthy, they are money service business. All we just see on our account, on the bank's account, is lengthy, but we don't know the destination of that money. All this real money transfer. We'll look into all of this, before. I want us to quickly look at that as well. All of this type of customer also is important. It's a key risk factor. And then the type of product that they want from the bank. There are certain products that are of like very risky, that are high risk, different products, even current account, because it holds money from different, it holds money. Correspondence relationship. Correspondence relationship is, a type of account or type of relationship with the bank. It's basically within the corporate banking. So whereby the bank, say Bank of America, provides service to another bank that has other customers. So with Bank of America, we have other banks, like even Central Bank of Nigeria. I've dealt with a case of Central Bank of Nigeria. They raised an negative news on Emefiele, something. Okay, so that is a correspondence relationship, because they have relationship with another client. So it's risky because we don't know their client. Do they do the right due diligence on their client? So there's a risk there. Okay, and then lastly, the way we've onboarded the client. Some clients, because of their level of, influence, power, it might just be one person just called one person, or referral. It might just be online for individuals, where due diligence is not entirely or properly or adequately done. So these are 5 key risk indicators, categories that the bank look at. When they look at it, they assess this, and then they want to ensure that if you fall into any of these category, they want to assess the risk. We are going to go deeper into that. Is it okay if we finish at 1:30? I think we had 1:30 on that call that I did. If it's okay to finish at 1:30, just thumbs up. You don't have to say anything. All right, grand. So by assessing these factors, financial institutions can allocate a risk rating to a customer relationship. So when we assess every customer and all this, we can say, okay, this is low risk. Okay, this is medium risk. Okay, this is high risk. So those are the 3 risk rating. So the customer risk rating. So after a customer risk assessment is completed, a risk rating is then assigned to that customer. Okay. So the risk rating is what determines how the customer would be perceived. Okay? Like I said, there are parameters in place. Okay? There are parameters in place that have been in place that would help individuals, you and I, the bank, to put the customer in the right risk position. Okay, so the level of customer due diligence is then determined. So the due diligence that we want to do on that customer, maybe to collect his name, verify and all that thing, is now determined based on the risk level of that client. Okay, I'm going to repeat that. So the level of customers' due diligence, the way they've come to Joy's house to receive, the level of risk that you have would determine how they are going to collect all your information, verify you, do all those due diligence on you. If you are low risk, they might say, we don't need to go to our house. We just look on Google, check the house number, if it's real and all that on Google Map. But if it is high risk and they feel like the product that you have with them is high risk product, and they feel like, oh, this person is the wife to the son of Tinubu. I don't know if I'm correct, Joy. They will say, oh, this person, let's do a high level of due diligence on this person. Are we following? Right. So the risk rating is an important parameter. I don't know if you have any question on this, please, I want us to feel to be very, very free to ask at some point, okay? You can stop me and all that. When you're looking at the risk rating, it is very important to understand this, okay? But, all right, I'll go on. If you have any question, please just stop me and ask, okay? So customer due diligence is a critical part of the financial institution's compliance program. The compliance program includes customer due diligence, and customer due diligence is the process in KYC. All those verifying customers to know that genuinely who they say they are, that process, that thing that you do is due diligence. Okay? That thing that you do is due diligence. That you are asking for the address, they came to your house, that is due diligence. Fulfilling that, all obligations, all regulatory obligations, meeting standards and requirements. It is customer due diligence being done. And this process helps business to identify and assess risk. Remember, we're not just doing it, we are doing it to ensure that every risk will not impact adversely on the bank, but it will be managed, it will be mitigated, it will be romanced. You get? So there are three types of customer due diligence. There's a simplified due diligence. If you're a low-risk customer, if you fall under the low risk, they'll just do a simple due diligence on you. If you fall under medium risk, they'll do a standard due diligence, the normal thing they need to do. They'll just do it. And then if you are a high-risk customer, they'll carry out an enhanced due diligence on you. Enhanced due diligence on you. So that means you must have an element or a factor fall under your profile. Maybe your business is oil business, or maybe, whatever, you might fall under the high risk category. Okay. That's why they have to carry out an enhanced, apart from the normal standard due diligence that they will carry out on you, they'll carry out an extra length, at an extra length. Okay, so I don't know if we have any questions quickly. If not, if we have any questions, any question, even if it's not on this call, you can ping me afterwards, or maybe tomorrow, any day, anytime. Okay, but I have a quick question. So the key risk factor. Can you mention the key risk factors? So I'm just going to really let us breeze through this session, this part. Mention the key risk factors. Anybody?
A political express person.
Political express. So that's the type of customer. That's the customer.
Right. Okay.
Yeah. It will be the type of customer. Who is this person? You know, that we, so they will notice that this person is a politically exposed person. Okay, thank you. Anybody else? What are that key risk indicator, the factor? We've mentioned 5 different. In fact, in the first category, there are series.
The size of the business,
The
nature
size
of
of the nature of the business. Yes.
complexity
Yes.
of the business
The
ownership,
complexity of ownership. Yes. Yes.
location and jurisdiction.
Yes. That's another one.
Product and service as well.
Yes, the product and service they said they will be getting from the bank or within the relationship. Thank you, guys. So the 3 risk categories that I've mentioned for CDD, mention the 3. Say again.
Simplified, standard, and enhanced due
And
diligence.
enhanced due diligence. Thank you. Mention any 5 risk. And then, you know what? I won't ask you to answer these questions. Okay, this question. So I'll just speed up to the next one, and then so that you'll be able to. But I want you to note this question because I'm going to ask it. Can you write it down, please? Mention 5 high risk factors with examples. Please note it down. Okay. All right. So let's just go on. Thank you. Thank you, guys. I want to talk about the common themes, type of people and all that you'll be seeing, the business and all that, like 3 or 4 of them. I'm going to be speaking about them before we end this session here. Okay. So the first one is PEP. I want to explain further on PEP and why PEP, a politically exposed person, is seen as a very, with high risk, So a PEP is also known as a politically exposed person. So a politically exposed person is referred to an individual, whether they are foreign or domestic, whether they are from America or they are British, okay, with a prominent public function. That means they hold a public position. They are in the place of, high level influence. So because they own that public function, they are seen as a politically exposed person. Okay, the governor of the maybe Bank of England, Commerce Bank, the Prime Minister, the MPs, all these people are politically exposed persons. So as well as their family, okay, and their business associates, okay, if we know them together, that, the woman in black and the man next to him with the red tie, they are family, and the woman in black is the wife of the president of Cuba or something. Do you get? This person, whether they are standing there for, I'm just trying to create an picture here, because they are seen together and they are associates. This person is also, even if this person just owns a limited company, but the fact that they are associated, they are seen together, even if they come up on the news together, and they are also seen as the RCA, that's the relation and close associate of the PEP. So RCA is relation and close associate, okay, of a PEP. So that's why you say RCA of a PEP. So the family members, relations, close associate are under RCA. So there's a PEP and there are RCAs. So if you hear no one say, can you tell me about, what do you know about RCAs of a PEP? You can just say, oh, they're close and relations and close associates of a friend. It could be the in-law of, it could be the friend, it could be the daughter or it depends on the level of relationship. All right, so because of their position and potential influence, PEPs often presents a greater risk for involvement in such crimes as corruption and bribery. Because obviously, we mentioned oil and gas, they might want to bribe people. Who are they going to bribe? You think if they bribe the secretary can influence things? No, it is the person that one. Okay, even if it's a local government chairman, it's a PEP because they can influence things locally. They hold a public position, function. Okay, so there are types of PEPs. Okay, so the Anti-Money Laundering and Counter-Terrorist Financing Act 2006, you can Google that, and have identified three different types of PEPs. So there we have the domestic PEP. So the domestic PEP is entrusted with prominent public role in a national government, in Britain, for example. Okay. We have the foreign political exposed person, a high-ranking political figure in a foreign country. We can see all the ambassadors, all these ambassador to something, or maybe he's a British, but is the governor of Bank of America worldwide, or he's a Ghanaian, he's a bank, G-get. So he owns a high rank position in a public, public figure in a public function. Okay. And then the third one relates to the international organizations. So say, for example, the UN, the WHO, NATO. So these persons, they have a prominent public member of an international organization. So that's the example of so those are the three types of PEPs. So my question now is, why are PEPs considered high risk? I know we mentioned earlier that because of their level of, or let's look a bit further. So a politically exposed persons are often considered high risk due to the nature of their role and the influence in the society. They can pull strings. So if that kind of person, they come to bribe that person to pull string and appoint Axion Mobile or Shell Oil Company or something to be in charge of refinery, they can pull strings. They can easily be corrupted. They can be bribed. They can be bought, They can use their influence to override laws, to want to beat laws because of the level of their influence. And if on the other side, they owe them as, say, for example, for blackmail, they can use them to exploit, to get money and, launder money. So it's because of their level of influence in the society. And given that they have access to public resources and influence over decisions involving significant, say, for example, amount of money in the government, they can say, tell the minister of something to sign, because they have influence. Okay. Because of that, they are frequently scrutinized. Why? Scrutinized by people, by the news, TVs, So you see negative news about them. You see different information out there about them. So they become risk to the bank. Or because of this risk, would the bank not have relationship with them? Yes, they will. They would continue relationship with them, but they need to just continue to find ways to caress and romance and find ways to mitigate all this risk that has been exposed to the bank. Okay, so the key reason why a PEP poses high risk is their potential susceptibility to corruption. At every point, they are suspected. Okay, and the susceptibility, rather, they can easily be corrupt. Okay, and they are even, targets to entities seeking favors, favorable legislation. Maybe there's a law on a kind of product, and when they reach bribe them, they can change the law so that this kind of entity can bring in their, there are different ways. So I'm sure you understand now why a PEP, is seen as a high risk. By the time we get this material, I would encourage us to read through the examples that I've added in there. Okay. And I have a scenario, example of a vice president of Equatorial Guinea, the son, and there's an example there that was being caught for, embezzling public funds and, money laundering. So we can read it, we can search. Okay. Yeah. Another case study involves the former Ukrainian prime minister. He was convicted in 2004. But in Nigeria, it's hard to, if the bank did not do their due diligence and they did not suspect and raise suspicious activity report, this kind of people also would escape, So please, I would encourage us to go through these documents. Once I'll be able to send to you after this session. This video, I want us to go through it. After the session, pause, rewind, fast forward, wherever you think you might have missed anything, okay? All right, so now let's look at examples of high-risk businesses. It's just a brief example, okay? So there are business types which are high risk by default due to their nature. We talked about countries due to their nature. We know that they are them for notorious, things. So there are businesses like that too. Okay. So there's cash intensive business. Cash intensive business. Without explaining, what that means. All these grocery shops, people can pay cash and they get a lot of cash. Car wash, they do cash. Laundromat, they do cash. Okay. These market shops and all this, they do cash. Gambling, they do cash. Casinos. So cash intensive business receive a significant amount of, receipts in cash. So examples of, cash intensive business, which I've mentioned, convenience stores, restaurants, retail stores, and all. So cash intensive business like laundromat, vending machine businesses, restaurants, lawn services, this is different types. The street vendors are often used to launder money. Okay. Remember the scenario that I gave, someone that owns a laundromat and then proceeds from criminal activity is being injected into the business, cash into that business because that business is cash intensive. So because of the large amount of cash flow into this business already, legitimately, it is hard to prove that the dirty money is being, cleaned with this business. It is just hard to prove. So that's why this kind of businesses are seen as being high risk business. So cash intensive business can be vulnerable to criminals or their criminal operator. That's the owner. And they can be used to launder proceeds of criminal acts. Now let's look at another one, extractive industries, which I've been singing about since the start of this training. So extractive industry consists of operations that removes metal or mineral and, aggregates from earth, natural materials from earth, because that thing is there naturally. And they know that if they discover oil somewhere, it is billion. We are talking about gazillions amount of money there. Okay, so examples of extractive process includes the oil and gas extraction, mining, dredging, quarry, all these stones quarrying and everything. So why are corruption risk so high in extractive industries? Why? So natural resources have the potentials to generate large revenues and profits, which makes them attractive to businesses. And then competitions often results in heavy lobbying. They want to lobby to become the refiner of this. They want to lobby starts. Okay. And through that, they tend to like bribery will start. This one will bring 1 billion. So for example, we have something here that I'd found out online way back. So a recent report shows that in 3 years after a Paris agreement, the world's 5 largest oil and gas companies spent over 1 billion on climate-related branding and lobbying. Okay, so they were just lobbying for just to get, I think it was a reserve that they found or something. So I'm sure we get that picture relating to extractive industry. So I'm going to go straight to this one, MSBs. I think I mentioned that earlier, money service business. So money service business is the money transfer or currency exchange transactions in general terms, MSB, which has many forms, such as individual global businesses, payments companies. So there are many forms. So they transfer, they do currency exchange, all those Travelex, all those, people use them to launder money. Okay, they use them to launder money. So that's why they are seen as being high risk. Yeah, high risk, because even on account, when we do account review, all we see is real money transfer. If a business, let's say this shop that you see in this picture was just a post office, and they'll be safe, that means the nature of that business at that time is low risk, just to say. And all of a sudden, they started doing real money transfer. Once the bank knows, then their risk rating will move from that low risk to high risk. Why? Because of this new nature of business. I hope we get that. Their risk rating will move from where it is to a higher level. Okay? So that is why there's a big risk in MSBs as well. So imagine if you have a business, you do money transfer for people, and you told the bank you do money transfer, they see you as a high risk. Okay, they see you as a high risk business. So I've just a quick exercise, and then we'll wrap it up for today. Just a very quick exercise for us. Okay, let me hide this. Can we see my screen, please? Can we still see?
Yep.
Yeah, okay. So this is a quick exercise. Joy, are you there?
Yes.
Ada, are you there?
Yes, I'm here.
All right. Tolu, are you there?
Yes, I'm here.
Okay. Anita, I want to ask if you are there, but are you there?
I'm here.
Not
Okay.
yet.
All right. So
Look, she go away now. Sorry.
would you leave us alone? I beg. So the bank is this is a quick exercise, you see. So the bank is onboarding the below customer. So I'm going to show us, and then I want us to carry out a risk, customer risk assessment you know, and this is required. So I want us to read it, and then I'll take us to a different slide, and then we can answer the questions, okay? Or let's do it this way. So example 1, ANZ Limited, incorporated in Luxembourg. The entity is a consulting firm with offices in the United Kingdom and would be receiving payments from clients in the United Kingdom. Okay. I'm going to answer this one. And then the next two, I want us to answer it. I'll call each one of us, and then I'll ask you, and then we'll answer. All right. So if we look at, bear with me. So can we see this? Hello?
Yeah.
Yes.
We can see.
Yeah. Okay, brilliant. So that business, if we go back to that example again, so ANZ Limited, it was incorporated in Luxembourg. The entity is a consulting firm with offices in the United Kingdom and will be receiving payments from clients in the UK. So there's a table here that I want us to see. It was, if you look at this top, remember the types, the categories, okay? So we have jurisdiction here, the nature and industry, we have ownership, we have products, we have customer type, PEP, and others, you know? So if you look at this, low risk, we have Luxembourg here. So you see Luxembourg falls under low risk, and it's a consulting firm, which usually consulting firms are low risk, okay? But however, it will now depend on who they are consulting for. But that information has not been given to us in that example. It's just an example, okay? Because they might be consulting for extractive industry. So that means they'll be getting funds from extractive industry. So we might move their risk level higher because they could be used for laundry, money laundering, okay? And then we know that payments will be coming into the account, as said, from clients in United Kingdom. And then if you look at it, London is there. So United Kingdom basically is, it's a low risk jurisdiction. So that customer, when we assess all those risks in terms of jurisdiction, the nature of business, with the kind of products that they have, and everything falls under low risk, then the customer will be rated as low risk, and a simplified due diligence will be done on that client when we are onboarding. On that client when we are onboarding. So the first question, what will be the customer risk rating for this? You know, the example 1 is a low risk customer. I hope you understand how I've arrived at low risk customer.
Yeah.
Okay, brilliant. So now I want us to look at the next example, and I want us to read it closely, ensure that we are not missing out any detail.
Okay.
Relating to the 5 risk categories. You know, when we're looking at risk assessment, always remember that 5 risk categories. XYZ Limited, incorporated in London. The entity is an extractive industry with all activities within the United Kingdom and is owned by Mr. Xavier Yankee Zulu. Okay, so if you finish, let me know. If you've read this, let me know.
Yeah.
All right. I want us to go back to that table and then note your answer. What will be the risk rating of that client? Always have at the back of your mind, one thing, one element or one factor might not be the drive, another might be. And whichever one that is, depending on the hierarchy, would remain. So if the one that drives is I, that means the client is going to be I. If all other risk rating is factor falls under low, and one element falls under I, will be, or if everything is low and one falls under medium, then the customer will be medium. Please bear that in mind.
Yep.
Okay. All right. So I'm going to go to the next one, the last example. Okay. And I want us to read this to ourselves, or I'll read it out. KG Scientific is a testing firm for agroscience, medical products, and other health care products testing. This entity is incorporated in Cayman Islands and has subsidiaries in 25 other countries, including Dubai, Malaysia, and the United Kingdom. This entity is owned by a trust and other limited companies. The settlor of the trust, that is the owner of the trust, is the former Minister of Health in Japan. I want you to read it again to yourself.
Quick question, please.
Yes.
Is America supposed to be in low risk list?
Yes, America is a low risk jurisdiction. Selfish, eh? America is low risk.
No.
Yeah, when I first found out, I said, okay.
I was wondering.
I know, right? America is low risk. You'll be surprised. I think India is medium risk, but I'll give you a site. It's called Corruption Perception Index, CPI. If you look at it online on Google, you'll be able to find different risk rating of all the countries in the world. Corruption Perception or Perception Index or something, yeah. All right, so are we okay with the example 3? Let me go to the
Yep.
So this is the table that we have. If you want me to go back to the example, to the scenario again, I'll go back, okay? So who wants to go first? With example 2.
Example 2 is high risk.
Okay. Does anybody disagree? Does anybody agree?
To me, example 2 is medium.
Medium, okay. Anybody else?
Yes, I agree. Example 2 is medium.
Medium, okay.
Oh no,
Anita?
sorry. Example 2 is low risk for me.
Low risk for you. Okay. So anybody else? Anita, Tope?
Can I see the screen for the examples, please?
Say again?
Can I see the page for the examples, please?
Okay, yeah, sure. Question 2. We are treating question 2 right now.
It's low risk.
Low risk. Okay.
Yeah.
So Anita,
For me, example 2 is low risk as well.
low risk as well. So why the low risk people? Why low risk?
Based on the fact that it was incorporated in London.
Any other person?
No, and
Number
all the
2.
activities.
For
Say
low
again?
risk, right?
Yeah, for low risk people. We have 3 people low risk.
It's sole ownership.
It's sole
And all
ownership.
of the activities within the UK. Yeah, it doesn't say anything else that seems like he's doing anything bad, if I put it that way.
Okay. All right. So the
Yeah,
person
it's
that
just like
said,
Mr. Zulu is a neutral person.
okay. All right.
Doesn't have any profile. Yeah.
Okay. So medium risk. Joy.
Okay, so the jurisdiction, UK is low risk based.
Mm.
and the operation is in UK, low risk base, but the nature of business, extractive industry, that's high risk base kind
So
of
why
business.
did you say medium?
So it's like the place where it is a low risk place, and then the kind of business is high risk. So I feel it's in between, it's balanced.
Oh,
So
sorry. Yeah, it's high risk. It's high risk business.
No, you can't change your answer now. You can't change your answer.
But
Stick to
it's
your
not concluded yet. It's not concluded. It's high risk. It's high risk.
No, it's
Because-
okay.
Because
So
it
why
has a
why you
clause,
say
and that
why you
clause
change?
is very dangerous.
I still have the floor. Medium is still medium. Say
No, I go for high risk. I go for high
Okay.
risk.
So now,
Okay.
I go for high risk.
okay,
All right.
because UK have laws that would restrict excessiveness of the high risk, the business, as the extractive industry has regulatory bodies that will make sure that the person, the owner, doesn't really exploit it so much, if I may say. So that's why I went for medium.
Okay. So the high risk, Larry. Why high risk?
It's just because of the nature of the business. It's stated that anything that has to do with extractive industry is high risk. I know the country is the jurisdiction is London, but we need to understand that it's nature of business supersede jurisdiction sometimes.
All right. I said something earlier before you answered. I said if everything is low and there is a factor of high risk, that client is high risk. Okay. It would now take, it can only take maybe, but with this, Larry Larry is correct. I'm sorry to say everyone is not.
I switch to high risk. I switch to high risk.
One leg here,
No,
one leg.
no, I can convince you on that. I switched to high risk immediately when I
All
saw
right,
the
fine.
extractive
Okay. You
industry.
shall have joined
Because
the winning team.
when they said within UK,
Yeah,
once the nature of the business is extractive, they
yeah.
can do some other transactions without recording it. The
Because
nature of the business is dangerous to that line already.
exactly. So the thing is, because it's an extractive industry, okay, we can't take that risk away from them. Okay, we know they are high risk automatically. Like I said, I said extractive industry, and I said by default they are high risk. Okay. Some industries within this list, maybe during refresh, when they're doing periodic review and there hasn't been anything to allow to say, oh yeah, otherwise maybe there's a fraud or maybe anything negative about them over the years, that based on a risk-based approach, they can drop their risk rating, but it's always rare. I'm trying to answer you, Joy. It is always very, very rare, on rare occasion. If it is an extractive industry, the bank is exposed to bribery and corruption. So at every time, at every point, they have to be checked. They have to be checked. Okay? They have to be checked. So that answer is high risk. Okay? But I think I like all of this rationale why we've chosen. So when a client is everything, the jurisdiction, everything is, low, medium, and maybe one factor. Say again. Joy, were you saying something?
No, it's okay.
So, and then the factor, there's one element that is, say, for example, North Korea or Panama, okay? It would elevate the risk rating from where we would expect naturally. It's just the way it is, naturally to high risk. The client becomes automatically perceived as an high risk client. It does not make the client a bad client. It does not mean the client is bad. It does not mean because the client in UK is in the UK and everything, so the client cannot be high risk. No. So if jurisdiction factors does not drive it, something have to drive it. Something else. So, and we have 5 categories. It could be the complexity of the ownership of the business. Any question?
No.
No, okay, thank you. So the last one, I'll
High
give
risk.
John.
High risk. High risk.
Why did you say high? Would you think it is high risk?
Everything about it is high risk.
Everything
Both
about it.
location, both the ownership. The ownership is politically exposed person.
Why did you say politically exposed person?
Because this, you said the person, I think in that question, governor or something.
No, former minister.
Former minister of health. And look at the other places that the company has subsidiaries.
25 other countries.
So everything is high risk.
So any other thing?
It's close.
With medical product as well.
So Larry, you were saying something.
Yeah, dealing with medical products as well, and healthcare.
Yes. Yes, that industry as well, pharmaceutical, medical, whatever, all this, it's a corrupt industry as well. Any other thing, any other reason? A lot of people.
The entities.
Stop it, Tolu Lopez. The entity.
The entities as well. Yeah, they have limited companies, trust and other limited companies. So the limited companies, each and every one of them have to make research on each and every one of them. So it's on high risk.
Yeah. So what would you call that? Complex.
Somebody help me, house.
Complex ownership structure.
Yeah.
Complex ownership structure because it's owned by a trust and other limited companies. You see, so in process, normal process for every organization, when the layer is 3 or more, so maybe it's owned by a limited company and is owned by another limited company and is owned by another one, we have 3 layers there. So we have the actual client, that's the KG Scientific, is owned by a limited company, that's the intermediary entity, intermediary entity. We have another one. If we have 3 layers or more, it is complex. Anything below 3 layers won't be seen as a complex ownership. Okay, it won't be seen as a complex ownership. So, but here, especially if we now have a trust within an entity, within the ownership of an entity, trusts are always seen as high risk as well. So if you go back to our table here, so think we have trust somewhere. Yeah, there's a trust here. So you see, we mentioned in the risk category, in the key risk factors, that the type of customer involved, also be, so a trust as well. Okay. Reason why trust is seen as high risk is because trusts are not operating entities on its own. It's not like it's the trust that brings in, generates revenue. Okay. So the trust is, remember the scenario I gave when I was defining it, whereby I have assets, I have wealth, I'm giving it to, giving the management of that wealth to a trustee for the benefit of my son. My son is the beneficiary. The asset is what, and other things, the money that I have is what generates revenue, not the trust. The trust could be Abimbola Trust. it's not the Abimbola Trust that is generating revenue. So the trust is a non-operating entity. And that it holds money only. It holds funds alone. It does not operate. So the funds could be coming in from anywhere, could be, anything. And that is why trusts are always seen as high risk type of client, customer. So, but we've done, I think I'm confident to say we have the knowledge of the CRA. Okay, so I'm just going to repeat. The customer risk assessment, after being completed, it helps the bank to know what risk level the client falls into. And that is what you've done already. Although the bank will not give you a table like this, but there are documents that you see countries and their risk rating, industries and their risk rating. Okay? You see types of customers, trust, type of products, everything, and their risk rating. So it's now there are parameters, like I said, in place. You will see, like when I was in Morgan Stanley, there's a portal that we go to. When we've gathered all this information, it automatically it automatically categorizes the client into the right risk rating, risk level. So another way that they do to calculate is an example. Nigeria, there are some risk countries, they might score 90, 100, know that. And the product 50, the product 10, different types, scores like that. The bank will tell you if a client, if you add all of those risk rating together and they meet maybe 0 to 40 and they are under 40 threshold, they'll be seen as low risk. From 40 to 70, if you add everything together and they are between 40 to 70, they'll be seen as medium risk. But if they go beyond 70 and above will be high risk. So there are different ways, okay? But it would depend on the entity, the organization that you will be working for. So if we are doing low risk client, low risk, we do it say every 5 years. It doesn't, because it's simplified, we still see that you dig it. And then there's a standard for like 2 years, 3 years, and high risk. But now businesses don't want to wait because something might have changed within a low risk and drive it to high risk. So we do what is called refresh. Okay, so and for low risk, they do if there's any trigger or something that changes, and we get to know. Okay, so but for the purpose of this training, we'll be focusing on high risk clients. Why? Is because if you are able to, that's the complex one. If you are able to do that, you'll be able to do simplified due diligence, standard due diligence as well. But because the enhanced due diligence, once you know it, once you understand it, you can do the first two. Because standard due diligence, enhanced due diligence is doing more than standard. So we want to know, I want you to know how to do that more, instead of us visiting simplified standard. So we'll be focusing on enhanced due diligence. Okay, so that wraps it up for this first session. And don't know if we have any question whatsoever, any question at this point. Any question at this point? If we have any question, please let me know. If we have any question, we've gone 6 minutes ahead of time. and I try as much as possible to remain 130. But thank you very much. You earned that break, but I didn't give you. I've cheated you. Don't worry. I'll give you back on the next session. I'll give you back on the next session. Is there anything you have to say? Any comment? I'm going to stop recording right now so that we have. Oh, did I stop sharing?